Let me start. Look, thanks for everyone for participating on this webinar. We are trying to give some value back to our clients, and as you probably have seen, we've been very active on writing white papers, especially on the US market, but we are slowly expanding into Canada. But also, this is something I want to give you as a news, we're also expanding to Europe, okay, where we now have a very good data coverage, still growing, and we'll have a lot of news in the next weeks. But what I wanted to do today is focus on what we've seen last year, what happened in Q1 this year, as well as where do we think the market is going to go in the next 6 to 9 months. So let's start. Okay, look, I'll give you just a big overview. We'll go through just some, look at how the derivatives market is going, and then we'll give you some of our European data and a bit of where we are in terms of the full outstanding products in both regions. As well, we will end up with some of the product trends we've seen in Q1. So look, I'm not going to spend much time here, but as you are all familiar, global growth is slowing down. The IMF prediction is that it's now going to end 2023 with the 2.9%. The good news is that inflation is slowing down, but still high. So they expect inflation to go to 6.6% at the end of 2023 and slowly go down in 2024 and 2025. And you also have the regional breakdown of growth, right? With biggest growth still coming from Southeast Asia, East Asia, and as well Middle East and Africa. Europe, it's basically flat with no growth. Something which will also be interesting, and we'll raise it, is of course commodities. Last year was a big increase on commodities due to supply chain problems, to the Russia-Ukraine war. And then later in the year started to slow down. Currently, you also saw a big pickup after OPEC Plus cut their production. So we see that in the short term, that's what will keep inflation still high. Now, so we wanted also to give you a bit of a forecast compared to today as well as a year ago. The index standard, which there's an excellent report on analyzing the top 30 asset managers, research houses. They aggregate the information and they use that data to estimate what going to be the next 10-year return on the different asset classes. And what's interesting is that compared with 1 year ago, their estimates have increased. The main reason behind that is not that they're becoming more aggressive or that the economic growth will come. As we saw in the previous slide, IMF actually thinks that this year is going to slow down. No, it's simply just because at the end of the year and the beginning of the year, you had a small bear market. And because of that, and you looking at the latest numbers from companies, we're just starting from a lower base, and that's the only explanation why for the next 10 years, compared with last year, there is a slightly potential growth on the different asset classes, especially commodities, as you can see. But also the US 500 large cap equities, which, of course, as you probably imagine, is the S&P 500. And of course, you also see there a big growth on fixed income. I mean, last year was a really bad year for fixed income products, right? As interest rates start to increase. Now, as interest rates are higher, there seems to be much more value onto fixed income. So what about derivatives and what it gets for structured products? So what we're looking here is a bit of looking at the different factors of structured products. First, of course, interest rates. I mean, compared with a few years ago, and you see on the top left chart, the US Treasury yield curve throughout the last years, from 2020, which was the yellow line, up to a few weeks ago, which is the blue line, you can see massive increase on interest rates. It's clearly now inverted, which it might be a problem for banks, but it's also an opportunity for the capital protected products, especially as interest rates are very high. What's interesting is that, of course, you get more value into the short term. Okay, but then you have a few other problems, especially with the dividend yield. So I'm talking about the chart on the bottom right corner of your screen. And what we did there is we looked at the dividend yield of the S&P 500 throughout the years, throughout the decades. And what we've seen is that it's at extremely low, at just 1.6%. And again, as structured products, issuers expect the dividend in order to offer cheaper options. You can see that's being a slightly problem, and we will talk more about that on the part of the trends. Okay. The good news is that VIX volatility is still slightly above what it was before COVID, but during the range of between 20 and 30, and that's something we've seen that seems to be the new norm after COVID. And last, of course, is the equity performances. What we see is that since the last 6 months, there was a small bear market, as you can see, from going from March last year to December. It's now being going sideways. The other thing which I want to mention before going to more data is, of course, we cannot miss Credit Suisse. What you see on the table on the left side, we did this analysis on the weekend that happened, the Credit Suisse UBS merger, and that was data as of Friday, how much of Credit Suisse notes were outstanding both in the US and EMEA. So there's a question mark there on Switzerland and Germany. The truth is that we can confirm that as of that Friday, there were $21 billion outstanding, up to 52 billion. So the real number will be somewhere between. What I want to show you is, in the US, there's still more than $7 billion outstanding on structured notes. And you can see also the most impacted markets after the US. Of course, we have Switzerland and Germany, but after the US will be France, more the institutional market with their own MTF. Some offshore, we estimate 1.4 billion, and then Italy and the markets. But that gives you an idea of that size. Since that happened, structured products issued by Credit Suisse almost came to a halt. We can still see some products being bought by some more institutional clients, so not really sold to retail. But most of those clients seem to look at Credit Suisse papers as UBS. So yeah, it's almost disappeared. What is more important, more serious, and I think this is going to be something that you will hear in the next couple of weeks, is losses on hedging Euro Stoxx Bank, so the SX70 index. During that period, there were more than 25 billion outstanding volume just linked to the SX70 index. And that fell 20% in less than 2 weeks, going from almost 120, 118 to 97. And of course, investment banks hedge some of this risk. They do buy the underlying, but what happens is because most of the banks, and again, most of these products sold in Europe linked to this index. Everyone has the same exposure. They can't really hedge the whole risk, and they need to buy the stock. That means that they had considerable losses on structured products, similar to what happened 2 years ago with the dividends, not at that level, but I think the losses were considerable, and we estimate there were around 1.3 billion euros losses between all the banks. Still, it is still significant, not as high as it was during COVID with the dividend yield issue, but still, still considerable. And I think there will be, a lot of banks, especially the main issuers in Europe, who on Switzerland and in France, that will have some of these losses. Again, we know the names, but we will not mention them, as it's still, they still didn't make that public. Let's looking at the global derivatives market and structured products. Now, before we go and show you our data, I think it's important we look at BIS data derivatives. And I mean, if you've never seen them, it's very, very interesting. As BIS gets all the data, all the OTC contracts that are done between institutions, they do analyze how the derivatives markets has been evolving. What you see is that you see all the outstanding volume from 1998 to today's half year, so semi-annual numbers. What we see is that since 2016 to 2022, there's been a considerable growth, especially, of course, on interest rate swaps, caps, floors, and so on. Considerable increase, going from almost 400 trillion to 500 trillion. And again, especially in the latest last quarters, where as interest rates start to increase, a lot of institutions start to hedge their interest rate risk. Okay, and on the right, you kind of have a bit of a split, because interest rates derivatives are much higher than everything else. You can see there some of the trends on credit, equity, commodities. What we've seen is that, and this is something that connects a lot with the European market, is a considerable growth on credit-linked notes and credit derivatives. It's small pickup as interest rates start to increase. The spreads between treasuries and companies started to increase as interest rates start to increase too. So there's been also a big increase of demand of credit-linked notes, and that's one of the reasons why we expanded our credit-linked notes PRIPS kits, and also commodities hedging. Slightly low in terms of outstanding on equity derivatives, as also equity markets didn't perform that well last year. Now, what you were all expecting, giving you some numbers of structured products. Again, our US coverage is above 95% of the whole market. Okay, and last year it finished just 50 basis points in terms of sales above the previous year. A lot of this increase, or this continuing increase compared with the previous year, has to do with Barclays decision, who returned $12 billion back to investors. Okay, a lot of them will roll over into new products. But we saw a growth in EMEA, especially more on the private banking sector, with a lot of auto calls, but also the comeback of capital protected products. Canada declined 6.5%, and that's our current estimate. Now, in Q1, if last year 2022 was positive, Q1 started really, really bad. I mean, January was a very quiet month, and they slowly start to pick up in February and March as equity markets start to perform very well. So We ended Q1 with US declining 1.3% only, Canada declining 10%, and EMEA declining almost 16% on investment structure products. Partially, of course, has to do with there were no rollover, no expiries, as you know, markets were down compared with the previous year. Okay, and that, you know, and of course you have the SVB, the Credit Suisse crisis, where a lot of investors just waited to see what was going to happen. Now, we talk about Q1. What's our estimate for the rest of the year? I mean, what we see is there is going to be a pickup, okay, in all markets. Okay, and the reason behind is, of course, it's all depending on the equity performance, but we've seen, depending on region, is that as markets start to recover, most of the live outstanding products started to become in the money. So in EMEA, so the one on the left, 52% of the products sold for EMEA investors are currently in the money. More interesting is the US, where 60% of the US products are in the money, and Canada, 78% of Canada products are in the money. Why this big difference between Canada and others? Especially because Canadian products are more long-term. There's a big last year GIC volume. GIC are the local deposit wrapper. And because they are more long-term, 2 to 3 years, you know, small crashes usually have slightly less impact. And that's why they still, you know, almost 80% are still in the money. Interesting enough, in the US, as I mentioned, January, February, there were no products expiring early. So just some coupons, some fixed and contingent coupons being paid, especially the Phoenix products. They're now in the money, and we see a big coming back of expiries in May, June, and then September and November. Those are probably going to be the best months in the US. In EMEA, we also see, you know, this 52%, which is of yesterday. You know, it's still at least we will still some rollovers coming back. What about product trends? And by the way, I think we have our Q&A and chat open. So if you have any questions about the slides or the data, please feel free to start writing those as we do the presentation. We will share the presentation for everyone who joined us. Okay, but just remember, yeah, if you have any question, you can, yeah, we'll answer at the end. Okay, couple things here. Interest rate products. I mean, last year there was a big increase, and what you see there is US interest rates linked volume on the left chart on the top. That went from 831 million to 4 billion sales last year, and this year is already at 600 million in the first Q1. Okay, and we also saw that increase in Europe. So on the charts in the middle, you have EMEA market share by volume, Q1 this year compared with the Q1 last year. So if interest rates were just 50 basis points of what we call the structured products, in Europe, they now represent 4%, and that's a very considerable increase. Then in the US, we also saw an increase from last year to 4%. Interesting enough, since the beginning of the year, we see a small decline of interest rate products as the yield curve change from the yield curve change to being inverted. Now, what it's become very interesting is the product types. So on the left bottom chart, you'll see all product types globally by global fixed income type. and you have the fixed to float, float to fixed, fixed to spread, spread and just floating. And I mean, floating has always been, of course, the most popular. But what we saw in Q4 was a big increase on fixed to float as interest rates were still high. And what we saw is this year is, you know, as people are thinking that the Fed will shift from hiking rates to stop hiking, we see a big shift between fixed to float to just simple floating products, and that's been a big demand, as well as callable products as a feature. Now, in terms of underlying sectors and regions, so on top, and again, we will send this data around to everyone. You'll see Europe, and then on the bottom, you'll see the US. In terms of sectors, quite interesting is that in the US, broad market indices like S&P 500 is been the dominated player this year. I mean, as vol is high, interest rates are high. We've seen that, you know, S&P, people are looking at just simple products on broad market indices, which is slightly different from Europe, that we've seen a big pickup on more sector-based indices, of course, in France, but also in Switzerland and Germany. Still, the Euro Stoxx 50 is still the biggest, but we see that financials come second with 10% market share, and then you have consumer discretionary and other sectors. What's also interesting is the underlying, and again, Euro Stoxx 50 still the biggest one, but what you saw is that follows by the S&P 500, Meta stock. It's also been performing very well this year. It's now on top 3 underlyings in Europe, especially on the private banking sector and brokerage. And then the Euro Stoxx Bank Index has been a very big bet with, of course, some single stocks that you can see with, you know, the BNP, by the UK, OR, Netflix, MCFP, Tesla, and others. Very different from the US, who's been just broad market indices, as you can see from the chart underneath. Last but not least, it's important to look at the exposure by region. Okay, what we see is that, you know, in Europe there has been a considerable exposure to the US broad market indices and stocks. Okay, Europe still with 16%, followed by US almost 60%. And other ones, but the opposite happens in the US, where 91% is just invested on US underlyings. Again, I think what we see here is a bet on US. I wouldn't say US as a country, but more as a US listed market. You know, as liquidity on those indices is much higher than it is in Europe. And then, of course, in Europe, decrement. I mean, it's been a big part of the French market, but it expanded. As for Q1, almost 8% of all structured products sold in EMEA are linked to decrement indices. Okay. More than half are broad market indices. So just new versions of the, you know, Euro Stoxx 50, of the CAC, and a few other indices. Okay, but then, and I think it's important to look at it, is the next ones, which are mostly linked to financial sector or companies, to equal weight and real estate. And I think this is quite interesting. And I think this is the reason why, if you look at current outstanding products, that's why in Europe products are not performing as well as in Europe, as in the US or in Canada, because there's been a big exposure to financials as well as real estate. You know, as there was an impact of interest rates increase in banks, as real estate is, as much people believe that going to be the sector that will be impacted the most this year with a hike of interest rates. Those products have not been performing that well. Of course, there are always specific products that are performing well. These products are still paying coupons, but they're not in the money to expire early. So yeah, I think if I am quite very positive about the US, and we increased our forecast, it's not the same in Europe, as there will be an increase on increased risk on these products. Almost at the end are the capital protected products. And again, these used to be the massive European market many years ago. And 2022 is where we saw a lot of issuers coming back, a lot of issuers, local issuers, national issuers, issuing structured products, structured deposits, and you can see that massive growth. Interesting enough, from 20 to 2021, Canada, massive growth, 56%, EMEA, almost 100%. In 2022, US, where we saw the biggest growth, followed by Canada, and EMEA slightly slowed down. What is also interesting is the product types, especially in the US, has been unlimited, uncapped participation products. In Canada, the very typical product is capped, so specific maximum limit on the products with a slightly higher participation. And of course, you have the fixed income rates, so all the income types, which are a big part of the US as well as the European capital protected products, which again, if people think about the old days where, especially in South Europe, where you would sell 2 to 3 billion euros with one product in the retail market, those products are now coming back. Okay, of course, because it's been a considerable trend during the last quarters, we also want to highlight is the underlyings and the product types. So on the left, you can see there, S&P, Euro Stoxx 50 in Europe, another underlyings being used. What it's been interesting is the US. There's been diversification, and the US on the capital protected in the past because of low interest rates. The proprietary indices like the JP Morgan Efficiency, the Goldman, the HSBC indices, they were very popular. But we see as interest rates are higher, you can see a more diversification, especially using the S&P 500, so broad market indices, but also share baskets. And you can see that in the US, where you can see others growing massively from less than 50% to more than 70% in Q1. But you can also see that in Europe, as those small issuers started to issuing capital protected deposits, capital protected notes, massive increase on different sectors, different baskets. And yes, this has come to a conclusion of our presentation. We'll just open Q&A and answer some of the questions. So feel free to send it to us. I think I already have one. Will a record be available? Yes, we will make a record available on our YouTube channel. But yes, we'll also share the presentation. Okay, I will just give a few more minutes. But thank you, really thank you for you to spend just half an hour listening to me. And of course, I'd like to thank Isabel and Chico who put the presentation together. Okay, If there are no more questions, yeah, I'd like to close. But once again, thank you for participating. Oh, we have one more question. Okay, this is very, very interesting. How will the trend shown change WST approach to solutions provided? We are looking at the trends, and we are upgrading our system. First is, look, we now start to cover the fixed income products, as they are very lightly structured. Depending on the bank, some of them consider them structures, some ones don't. We start charging that so we can see the trend. Currently, we expanded our credit link notes, PRIPs. Another thing that we are also doing is start covering those products, and you will see a big pickup, and we'll probably do a small article on the SPI website on credit link notes. This has been a big topic. And it's not only that. Look, we're looking at value for money. By the way, if you didn't read the white paper we wrote, we made it public yesterday. Please have a look. It's available on the SPI website as well as on the WST.com. Okay, and besides looking at value for money, we are expanding our data schema to include all these new trends. All these new trends. Perfect. Okay. Yeah, one more question. No, I think that's it. Look, thank you very much, everyone. I hope you have a nice day, and I hope to speak with you soon. Take care.